Hey, it's Lorne here from Dominion Lending Center's Expert Financial, optimalfinance.ca. So, where are rates going? I am getting realtors calling me saying, what do we say to our buyers? What's happening with the market right now? Lauren, do you have a crystal ball? Can you tell me exactly what's going to be happening down the road? And you know what? It is interesting times because it's so many different factors that we're kind of in uncharted territory in some ways. When we look at a few things, so when we look at where interest, obviously when the Fed did 1% interest rate hike, we went from where prime was at 3.7 to 4.7. All things considered, we were at 3.7, and before COVID, our prime was at 3.95%. So we were below what we were before COVID. Okay, so now they just raised the needle, raised it more than we ever anticipated they would raise it, and now it's at 4.7. What we've definitely seen a change in the market, and inflation is a big key indicator. Let's back up. Let's just see exactly where we're standing right now. So Canada really is, has some pluses on it. It's really still outperforming in terms of commodities. So the GDP and everything else is really strong, except it is on a decline. Things are slowing down. One of the things that we would expect that by the fourth quarter of 2022, it's going to be down. So that's the one thing. What about jobs? Okay, how are jobs? There's over 1 million jobs available in Canada right now. Over 1 million. This is unheard of, unprecedented. Probably 100, I think it's 135, 134, 135,000 of them are in the health sector alone. And we've heard issues on the news and everything else where challenges are we having in the health sector with staffing. Okay, so it is a big issue. So you got a country doing fairly well with GDP, so many job openings. And then the other thing we got going here is we have influx of a lot of new immigrants, over 500,000 a year coming into Canada. 60% of them are going to be settling in Ontario. They're going to be bringing a lot of the money and everything else to fill in a large portion. They're coming here, there's jobs for them. Okay, so that's the big thing. But we have, jobless rate is definitely at a record low. Hourly wages seem to be increasing, so that is on the trend upwards. But the big thing that's happening is inflation. So inflation is way over target. It was 8.6% in May, 7% in June. It was over 8%. So it has continued to be increasing. What is the government of Canada doing? So listen, we talked about Bank of Canada, probably, I think I did a video maybe a year ago, and Bank of Canada said, hey, economy is strong, real estate strong, expect interest rates to stay low till probably well into 2023. Obviously, they're changing their tune right now. Inflation has definitely been a factor. What do they do to combat inflation? They adjust interest rate. Does interest rate affect inflation? Well, not really directly. Interest rate, basically, by increasing the interest rate, their hopes to do this is to slow down the economy. And by slowing down the economy, it would effectively have a net effect on overall inflation and start bringing that number to more realistic levels. So I get the calls, okay, where's the rates going to go? Should I be locking in or should I be staying in a variable? Now, if you have a good discount off your variable, then I'm going to give you kind of a couple of different scenarios. You're going to hear stuff in the news. Banks will come out and say, hey, listen, good time to lock in. Rates are going to be whatever. I've heard somebody call me saying they heard that rates are going to be 10%. I was like, where are you getting this information? I would anticipate, if we look at the variable, I would anticipate with the way inflation is going, that the Bank of Canada is going to target, they're going to target probably between 5.2 to 5.7% by the end of the year. Okay, so that's what my anticipation is. If you have a discount off that prime, if you're on a variable, if you're prime -1, prime -75, you're still well below where 5-year fixed rates are right now. So should you stay variable or should you lock in? Here's my thing about locking in, and you're going to hear a lot of things in the news, and you don't hear the good stuff. Media is all about fear. What will scare people? So banks will try and get you to lock in because they make a lot more money when you're in a locked in term, okay, especially 5-year fixed terms, and they make a lot of money on penalties because we know that's close to 70% of them get broken before 5 years, right? So that is part of their objectives, right? So they want to try and make some money. They're in the business to make money. The other thing too, then people say, well, what happens? There's going to be a recession. Well, what happens when there's a recession? Government needs to start stimulating spending, which basically means they're going to be lowering the interest rates. If we do end up hitting recession, right now they're saying maybe 50-50. 50, then eventually what's going to happen is the interest rates that have been going up have been going down. Also, recent trends, we've seen bond yields kind of flatten, and the 5-year fixed have come down in, over the last week or so. A lot of the lenders have lowered their rates on their 5-year fixed, but you don't hear that in the news because that doesn't instill fear. Tending to think that maybe the 5-year fixed are kind of, basically going to be sort of right around where they are right now for a little while. Yes, the government will be increasing the prime again and again and again by increments. I would not expect increments of 1% like they did before. That was a huge jump. You just have to keep in mind, okay, what is my discount off my variable? By staying in the variable, you're just giving yourself a lot more flexibility because, again, just remember when you lock into a fixed term, you're probably looking at penalties 4 to 5% of whatever the balance is to get out of those mortgages if you ever need to get out of those mortgages. So that's important to know. Canadian housing market, here's the thing. There's been a big plunge in, if we look at GTA, in sales. Okay, so sales are down 41% year over year if we're comparing, for the month of June. Listings are surging. Probably is pretty much close to the same level they were last year, but the average prices are falling because there's more inventory. Because of sales have decreased, there's more inventory in the market now. You got a lot more price competition, everything else, everything's starting to adjust, and therefore, you're seeing prices go down. So within Toronto, it's been about a 41% decrease. The probably the best market in Canada right now is the Calgary market, right? So the Calgary market has seen a moderate decrease in sales, but also a moderate decrease in the listings as well, but pretty much maintaining its levels. And that could change over time as well. So what we're now seeing is the market change. What used to be a seller's market where you would have multiple offers, very little inventory, houses were selling really quickly. Right now we're in the range of a balanced market, but heading towards a buyer's market. Is now a good time to buy? Well, potentially yes. I would say, definitely, people are saying, should I hold off on, buying real estate? I think real estate's always a great investment, and sometimes it's really hard to time the market. Just recently did a podcast and I seen everybody's trying to wait till it's going to bottom out, but you won't know until it bottoms out, so it starts going back up again. Realistically, houses shouldn't be increasing by 50% in value over 1 year. This adjustment is going to be sort of a real adjustment. It's going to kind of get things right back to where it should be, because if you look at any house price, if it's starting from 3 years ago, 4 years ago, 5 years, whatever, over the next 5 years, you're going to see a steady increase in value year over year. Just there will be an adjustment from that 1 year where it went up and then back down, but you have to remember 500,000 new immigrants coming in. CMHC did a stat. Okay, so CMHC research showed, but to keep up with the housing demand, with the influx that's coming into Canada with homeowners looking for homes, and obviously new immigration coming in to help stimulate it as well, they need to build 3.5 million homes by 2030. 3.5 million homes by 2030. That's 7.5 years from now. They're not even close to being on pace for that. And now with some of these recent changes in the market, we are going to see some of these construction projects have slowed down or stopped because when there's labor shortages, there were some labor strikes, the cost of goods and everything else has slowed down some of this production. Those are also factors. Now, the other thing too, when we're actually looking at purchasing now in today's market, we are seeing some gaps, okay, in appraisals, okay? So basically from purchase price to the actual appraisals when they come in, because if I went and bought a home for, let's say, $700,000, and now there's a whole bunch of listings and these houses are listed at $650,000 and are not selling, the appraisal when it comes in won't appraise at $700,000. It's going to say, hey, listen, these are comparable houses. This is probably more like the price that it's going to be. Particularly more in the higher end houses, we're seeing a larger gap between some of what those appraisals are coming in. And you got to keep in mind that when you are purchasing, if an appraisal is required, and it's usually required if you have more than a 20% down payment, if it's less than 20%, it's insured and there's an auto approval system in terms of if it fits within a range, there's less likely to require an appraisal if you have less than 20% down, but 20% down or more, because it's not insured, the appraisals are just generally required. What happens is if the appraisal comes in less, you got to make up that difference. The advantage right now where the market is is from where it was a seller's market where you were competing against so many other offers. You could not put conditions in those offers. Now what's changed, I see the offers coming in with lots of conditions. So a condition on financing, condition on home inspection, et cetera, et cetera. So it's protecting the buyers in the way that buyers should be protected when they're actually purchasing the homes. Because even if you have everything's good income wise and everything else, but the house appraises for X amount less, you have to come up with that difference. If you don't have that difference, it's better to know during that financing period that that's the case. So when an offer comes in and it's conditional on financing, we make sure the income is satisfied and make sure that the appraisal is satisfied. So before you waive those conditions, so there's just no surprises. The other thing too, so higher interest rates has removed some people from the market. So right now we're going through all our previous pre-approvals and say, hey, listen, you know what, we need to revisit this, because if you were pre-approved at a certain amount, we have to preview what's called the stress test. And the stress test is whatever your rate is plus 2%. And with that, where rates have started to go up, it's obviously, if we qualify, you see 5.25% right now, but let's say a prime rate is 4.2. We now have to change it to 6.2 that we would qualify you at, etc. If you're looking to try and purchase something and you want a locked in term and that rate is say 5%, we have to qualify at 7%. You're actually going to qualify for less of a mortgage at a fixed term than you would at a variable term, just because of the rate difference. So that's also important to know. So where rates are going up, it's removes some people from the market, some people are waiting. The other thing, when I talk to some of my buyers, they're thinking, oh my goodness, the prices are going down. This is great. I'm going to wait. Okay, so maybe if this price goes down to here, then I'm going to make that offer. But if also the rates are increasing as well, they may no longer qualify for that mortgage. So it's something to look at. Make sure that if you had a previous pre-approval, you've seen rates adjust, we need to revisit and see exactly what you qualify for now. So that's really, really important. When we talk about rents, so even investors could move to the sideline because mortgage payments are increasing faster than rents are. With that said, even renting right now is tough. There's not a lot of rental inventory into the market as well, and rents are pricey in many of the hot markets. We could see a slowdown with investors as well. That can happen. And like I said, it's with the amount of houses that still need to be built to keep up with the demand. It is a lot. Okay, so you have to anticipate that what happened is, even if the market is going like this, you have so many people coming in, supply and demand. As the demand increases, even if the market is kind of unstable or maybe a little bit more unpredictable, the demand for housing is still going to be there, which is really pushing up. It's going to increase the pricing over time. It's going to make it consistently go up in value because you just can't build enough. When we talked about building and we talked about labor, there's obviously labor shortages. They're trying to bring as many more people into this country so that we can actually fill in this labor gap that we have. But we also look at residential construction costs are surging. There's recent articles that came out. I haven't seen one across my desk yet, but new builds. So those of you that are buying from a new builder, you got to make sure two things. One is your realtor that you're using. Hopefully you're using a realtor when you're dealing with a new build to help you screen things, and your lawyer. Make sure you review those agreements, because at the end of the day, on closing, they can actually add on a surcharge. Okay, depending on the wording of the actual purchase and sale, they can add a surcharge for above and beyond expected construction cost. There was one recent, I think it was in Port Credit or some area like that all of a sudden they got to the lawyer and they had to come up with another $100,000 of added construction costs that they actually put into that home purchase. And all of a sudden you're scrambling. How do you come up with an extra $100,000 in construction costs? Stuff like that. It can be a potential nightmare, right? So you just want to make sure that it's navigated properly. Make sure you go through those agreements and make sure there's an escape clause. And a lot of times there is. They'll say, hey, listen, no problem. If there is an escape clause, if you can't come up with it, they just resell it. They give you back your deposit, I assume. But again, stuff you need to talk to your lawyer about to make sure that stuff is for sure covered. We do expect that there's going to be some housing developments that are going to be canceled or postponed because of these rising construction costs. Interest rates are rising. There's a work shortage, material shortage. The loans are more expensive. So we could expect that some of the pre-constructions could be sidelined for a while. In summary, what are we looking at? We're looking at house prices. You can see them to decline from what they were over year last year, and might even get down to sort of pre-pandemic type levels with maybe an increase from what it was pre-pandemic, but marginal. It won't be the 30% or 50% or whatever it is in some areas, which is just not normal. You would expect that to see that some of the renovations and house construction is going to drop. It's going to slow down just because of the fact that we have all these other factors with the labor shortages, cost of goods and everything else. We need that to be a little bit more, we need more certainty. That's all we want. Like in our minds, and this is where you see, buyers on the fence and everything else, is because we want certainty in our lives, right? And there's just so many things that we're uncertain of. We would expect that with the activity, the influx of immigration, I'm thinking that everything should be stabilizing probably, within in 2023 we should see a stabilization because of the demand. Okay, that's still going to happen on housing, and then I think considerable growth will start resuming in 2024. So you'll hear different theories, different reports. A lot of my sources come from Dr. Sherry Cooper, great economist, and she really does a great job analyzing, done a very good job at predicting kind of where we're at and where we're heading to. What do I tell my buyers? Is now a good time to buy? Real estate is always a great investment, and particularly if you don't own real estate, you're renting and everything else. Now is a good time. As a buyer, I would say much better time now than when it was 6 months ago or a year ago when you were competing against 30 offers, overpaying for that particular property. You can now put a lot more conditions in to protect yourself and make sure it's the right situation. When you pick your mortgage, whether it be variable or fixed, it's so important to understand that having a mortgage with the lowest rate and the wrong strategy could cost you thousands and thousands of dollars over time extra. So it's very important that you make sure that strategy and understanding where your goals are, where you need to be, is so important to consider, because at the end of the day, if with the right strategy can help you reach your goals, your destination years and years sooner than you ever anticipated, it's going to give you opportunities to leverage the real estate to build your net worth. And like I said, over time, real estate is a great investment. Listen, I hope some of this answers some of your questions. I get lots of questions. Don't hesitate. There's going to be a link in here if you want to set up an appointment with me. Just click on the link below. We can go through if you have existing mortgage you want to sort of analyze to see where it is. I'll give you some unbiased opinion in terms of where you're at and where I think you should be. And feel free to lean into your mortgage professional to actually help you navigate this landscape. And I don't think you need to be overly fearful. I think that you got to look at where your jobs is, job security and everything else, where the country is. We're in a good position, very good position job wise. And again, people worried about where rates are and what happens if we hit into a recession. Well, if we hit into a recession, rates go down. So maybe hang on to those variables, because you might be paying a little bit extra now, but maybe another 2-3 years and it's back down again. But if you got stuck into this 5-year fixed, then it's going to be man, how do I refinance 3 years from now to get a lower rate? And it's penalties. You're talking about penalties again. So I hate penalties. I guess you get that impression, but I just hate penalties. Anyway, we're here to help. Any questions you have, please don't hesitate to reach out, and looking forward to seeing you on our next video.